Well, we're to Module 4 for Week 5, and we're going to be discussing ethics in charitable gifting. I think probably some people are surprised at that, but the ethics is very important from a tax standpoint, from the standpoint of being a financial planner, and how does that relate to charity. And that's what I want to cover in this session, is how it relates to a financial planner and charity. Our objectives at the end of this module will be able to, first of all, describe the ethics standards required of a financial planner's fiduciary, professional fiduciary, list the items to go through with the written advice for a client on tax matters, describe as what is meant by a self-assessment tax system, and list the 230 requirements for a competent practitioner. Again, if you're not you don't handle trust yourself, you still may be subject to professional fiduciary rules because you're doing the investment review for a trustee. Anytime you're doing something for a trustee, you are going to be in a professional fiduciary role, which is very restrictive. You're also going to be subject to any tax advice. You're subject to 230 of the IRS circular. So I would say almost every financial planner who is not a tax preparer is a little shocked by this. Let's start off with the 230 circular. It's applicable for financial planners providing any type of advice on charitable gifting regarding taxes. If you ignore the tax issue, no problem, but I don't know how you avoid the tax issue and do your due diligence for your client. Ethics standards are included in this circular, and they'd be worth your time to look at. It'll also tell you what you can and cannot do as an advisor on taxation if you are not an enrolled agent, a CPA, or attorney. You might be surprised at how much you can do. As I tell my students in some of my classes, my tax return could be done by my dog if she was a better speller. There's no federal rules on who can do your taxes, but tax advice is something else. You assume a fiduciary responsibility. Key for ethics compliance: first of all, written advice is not defined by the IRS, but it's accepted that comments on impacts of proposed tax regulations are not included. So if I talk about what I think Congress is going to do after the election, that is not a problem for ethics or having to have it written advice. If I'm talking about current law, I should be giving the advice in writing. Verbal advice is not good, and quite honestly, every financial planner should realize you're supposed to document everything with your client, and if you're not, you're probably setting yourself up for a lawsuit. Tax advice must base all written advice on the following: reasonable factual and legal assumptions. You can't be creative. In other words, you have to have relevant legal authorities and relate the law to the relevant facts. Have reasonable reliance upon the facts and circumstances of the case where you're providing written advice. All relevant factors the advisor knows or reasonably should know is included. And finally, reasonable effort to identify the facts relevant to written federal tax advice. Probably tells you right now that you probably shouldn't give tax advice on charitable gifting at all unless you're willing to do all of these activities, which means you got to do your research, you have to do your due diligence. Failure to do so, you're probably going to get yourself in a lawsuit or with trouble with the IRS. The ethical standards are included in the IRS code, and so it's serious when you're giving advice. We have the 6 and 6894 series of penalties. We have the 6 and 216 confidentiality, which is criminal provisions, the 7613 confidentially civil penalty provisions, and we have the 7525 privilege rules. So quite candid, if you aren't familiar with those, you probably shouldn't be giving advice on charitable gifting. How long does it take to get to that? Well, you use your search engine, go to the IRS code sections here and look them up. They're very straightforward. Even I can understand them. A competent practitioner, again, staying with it, if you're going to give advice on charitable gifting taxation or work with the client on it, you need to, according to Circular 230, you need the knowledge, the skill, the thoroughness, and preparation in area of engagement, which in this case is charitable gifting. In fact, anytime you deal with taxation of any type, with your clients. You're expected to have the knowledge, skill, thoroughness, and preparation, or again, you haven't done the due diligence and you're subject to lawsuit, which most people are aware of. And what I find is funny, if you do tax returns, it's pretty hard to be guilty of anything. But if you give tax advice, you have the fiduciary responsibility, much different role. Quality control, financial planners advising on charitable tax practice should have tax practice level quality control system that provides reasonable assurance of compliance to taxes and other laws and ethics standards. And again, these softwares are relatively easy to obtain. You get a better feel for it when you read Circular 230. Tax system is a trust but verify system. The self-assessment taxing system used in this country relies on voluntary compliance by taxpayers. Thus issues of ethics come into play and taken very serious by the IRS and also by personal liability of the advisor. Intentional noncompliance is a serious and pervasive problem, which believes to come from general belief that tax rates are too high and individual ethic beliefs and standards. These are really the two things that causes noncompliance. If you feel the taxes are too high, there's a desire not to pay it, and if you have, based on your ethics and standards or ethics and standards of your client. Again, you as an advisor must comply because of the fiduciary responsibility you have as a planner, which is different than the tax preparer, has actually less liability than as a tax planner. High tax rates. Studies show that the American individual believes that the price or tax is too high. They tend to ways to get around the excess. And many people feel that way. I mean, even people on the 15% tax bracket and 10% feel there's too much taken out of their paycheck. Ethics. Individual standard based on background, culture, and risk level. For example, the mafia has a level of ethics, and they probably pay their level of ethics much better than the average lawyer, CPA, or financial planner does, because they have serious consequences if they don't. I might note also the Muslim terrorist, same type. They have a level of ethics that they live with, probably again better than accountants, CPAs, lawyers, and financial planners. We have to live with the professional ethics established by the governing board, the CFP board, and also by any association we belong to. So if you belong to the Financial Planning Association or any other, and you have the professional standards required by your company you're working for. And then government use of the term ethics is entirely different, and they are legal requirements, i.e. tax ethics. So when we talk about individual ethics, that's something you and your practice can set up, and the penalties would be within your practice or your personal life. But when you talk in terms of ethics with government issues such as taxes, then it gets a legal liability, and you can actually wind up going to jail. Despise people. Summary. In this module, you learn the standards of ethics required of a CFP financial planner practice practitioner providing advice to clients and charities, because also we have financial planners giving advice to charities, is covered. And again, there's a lot of responsibilities with it that you probably weren't aware of. The information in IS circular that affect the financial planner providing tax advice to a client on charitable gifting is a guarantee. You have to read it. And we also had some of the IRS code sections that talked about the penalties. And finally, we had the need for a quality control system that requires a good set of ethics standards. You need that for the documentation required as being a financial planner with fiduciary responsibilities, as well as, I would say, being a good financial planner, meeting the needs of their clients. So I would say that this particular module may be of a surprise to all of you, unless you are a tax preparer or you've had good training in taxation.